Hello and welcome. Hello and welcome in the next Smart Money Concepts video part 4 fundamentals, order blocks, imbalances, and liquidity. So let's put this to the side quickly. We don't need that for now. So you see, I already drew some candles here. Just to give you guys an idea, the dotted lines are the wicks for now, just to help you understand. First, we're going to talk on the concept of an order block, an OB order block. Now, an order block, when there is market structure like this, prices going down, then how does a bullish order block forms? Well, we see the last candle in the downtrend. If the first bullish candle is smaller than the last bearish candle, then the order block is considered as this would be an invalid order block. Let's duplicate this quickly, because we're going to speak on imbalances later. Let's move this to here. Well, you can see now what would happen. How would an order block be considered valid if the last candle in one direction, in this case in a downtrend, is smaller than the first upward candle? So actually you see there is some kind of liquidity here, then the order block can be considered as valid. An order block becomes even stronger when it has an imbalance right in the second candle in the direction. Let's say we even have a third candle here. We're going to clone it again and move it. And you see, you always have the closing price and the opening price are always at the same level. Candle closes, next candle opens. Candle closes, next candle opens. Now we're going to use the former wick here to show you guys. If this wick is here on top of this candle, then you see, and let's make another wick for this candle, let's say. Now you see the imbalance in price is here between the high on the order block and the lowest part of the candle. And here we have to change it again. That's trading. Get used to seeing this. The background, let's make it less clear now so we can see through it. This would be called as an imbalance in price delivery. And we also call it a fair value gap. If there would be a direct candle going up, you could have an imbalance on a higher time frame with lower time frame fair value gaps. We always do our technical analysis top down. That means from day one to the hour, to the 15 minutes, to the 3 minutes. So we can look for these imbalances. And why are they so important? Because we've seen price coming down here, formed a valid order block. It gave us a fair value gap and another fair value gap here. You see, this is now another fair value gap. Let's quickly put some wicks here to show you that this fair value gap, we're going to take it out of the equation for the example. So this fair value gap has no liquidity in it. We only in this model we have liquidity in the second consecutive candle. Because price was trending down, we made our market structure shift here. Let me put the market structure shift to show you guys closely why this is a valid entry model too. You see price goes above the latest low, above the latest high that broke the low. Because here we had the break of structure, of course. That was the last break of structure. You see, and now we're in a market structure shift, and we consider this as a valid entry model. If it happens on a higher time frame, on the 1 minute time frame, you always have to be in line with your bias, or most of the times. If it's for a simple scalp, it's another story, but that's too soon. That content, most people aren't ready for this. So what happened here? We got a higher high breaking the structure and giving us a market structure shift. And 9 out of 10 price will come back into this fair value gap, mitigate sometimes just the top, sometimes 50%, sometimes the 100%, even draw wicks through it. But as long as the fair value gap is respected with whole body candles, we can conclude the trade as a valid position. So here in this case, we expect price to go up more and go there. Now, if you would see this in a trade as the entry model that we spoke, so our stop loss would be below the order block. We can even put it a little in the middle of the candles. And if we would aim for liquidity, there is always resting liquidity above old highs and below old lows. So if this was the latest high, then we can conclude that this trade we would get up to a 1 point risk reward 1.12. And that's a nice trade, especially if you see we expect the fair value gap to be broken. Order flow picks up your limit order, or you enter in a market execution here, how you prefer to trade. Everybody's got his own personal style. And this is how valid order blocks, fair value gaps, and liquidity to target with your take profit is formed. This is a valid setup that I use daily. And of course, the other way around, let's go quickly into it, see if we still have some time to show you guys. An invalid, a bearish order block. Let's take this away quickly. The bearish order block would look like this. Being a little impatient because time is on the run here. You see the last candle down, the last candle up, and the first candle down is smaller, so it's an invalid bearish order block. The valid bearish order block is formed when the first candle is bigger than the last upward candle. So this is a valid bearish order block. We've seen the bullish order block. So I hope you learned some things out of this video. Give us a comment, like, share, and follow so we can keep making more of this content. And I'll see you in the next Smart Money Concept videos. You can also ask questions. I will always reply. Thank you and have a nice one.